The market didn't believe it. The Fed has been running monetary policy like a drunken sailor on shore leave for decades, but particularly since 2008. Need a couple bucks? Here's a trillion. Bernanke, Yellen, and Powell all handed out money like Jehovah's Witnesses handing out pamphlets. But it looks like generous Jerome Powell is no longer generous, but becoming a tightwad. The market expected Fed funds to peak in the first quarter of 2023. Then they started thinking first quarter 2023. Now the market is thinking June of 2023. First, they thought that the peak would be in the high 4% level, then 5%, now 5.25%. But I think that number is going to go higher now. The date of the peak funds rate keeps getting pushed back and getting higher. This is not over yet. We will see rates at a much higher, probably break 6%, and they won't peak until late this year. But, and it is a big but, Powell may repeat the Volcker mistake and ease too early. Paul Volcker believed that he had defeated inflation in 1980, but had crushed the economy, so started to ease monetary policy. But inflation came back with a vengeance, and Volcker had to tighten even more to finally put a silver stake in its heart. To me, I have largely expected for Powell to make a Volcker mistake. Why? Because of Powell's massive easing in 2020. Yes, it was a crisis, but he added an amazing $4 trillion to the money supply over a lunch from a hot dog stand. The biggest monetary easing in U.S. history. So my feeling was that he was going to go full banana republic if the labor market showed any sign of weakness. So far, the headline labor stats have been strong, though weakening around the edges. Big tech is laying off faster than a young Dubai man in a Lambo. Frankly, I thought the economy would be weaker by now. Manufacturing is already in a recession, but the rest of the economy is hanging on. I believe that inflation will stay higher longer, so the Fed would have to stay tight longer and higher than the market expected. Now the market is catching up with me and looking for the Fed to slow the tightening but make it higher later. So a slow increase, not a short, sharp increase. They no longer look for Powell to take a chainsaw to interest rates, but to tighten by paper cuts. So what does that mean for the markets? Look for bonds to dip over the next week or two, the stock market to also dip over the next couple of weeks. Gold will also dip, but the dollar will rally. All of these moves should be considered to be counter-trend moves, not changes in trend. We'll talk to you later.